there will be continued chaos.
So if you're an existing homeowner, what should you do? Hang on to your property for now?
Hang on, wait, watch, become very observant next year or the end of this year. If you're a renter and your lease is up, it's time to start shopping, and you better shop hard because there are some great deals out there.
We're talking about the U.S. and Canadian housing markets. The housing market and real estate markets are things that everybody pays attention to, whether or not you're an investor, financial guru, student of finance, or just a regular homeowner or renter. Housing affects us all. Ron Butler joins us today. He is the host of the Angry Mortgage podcast and principal mortgage broker for Butler Mortgage. As of July 2025, the U.S. housing market remains somewhat sluggish. Price growth is slowing, inventory at multi-year highs, and new home sales are down sharply. So what's next? Ron, good to see you. Thank you for joining the program once again.
Great to see you, David. Thank you.
You and I talked about the Canadian housing markets extensively last time. People can check out our last interview, link down below. We'll revisit the Canadian housing market once more. We're speaking the day after Canada today, but we'll start with the U.S. market. So today's CNBC report shows U.S. mortgage rates dropping to 6.79%. This is the 2nd of July, sparking a 7% surge in refinance applications. Can you explain why homeowners are all of a sudden rushing to refinance now, and what this means for the average person thinking about mortgage options right now?
Well, there may be a reaction to the possible passage of the Big Beautiful Bill. The Big Beautiful Bill rattles bond traders, rattles treasury traders. The thought is that we will see another increase in yields once the bill is passed. And nobody wants that. That will push mortgage rates back over 7%. And it's always a good reason to do a mortgage, is to take advantage of timing. If you think the rate's going up, you may not love the rate you're getting, but it's better than the higher one in a month.
Well, where do you think mortgage rates will be headed from here?
I see no particular reason for rates to drop substantially in the coming months. However, that said, Jerome Powell hasn't stopped talking about the possibility of cuts. It's not like he's taking cuts off the table. The dot plot calls for cuts still for the balance of the year at some point during the year. There's a case to be made that inflation is not as sticky or as certain or as definitive as the Fed has sometimes described it. So we may actually see some rate cuts. We may see some lower treasury yields, but that may not be till the end of the year, and that's not very good. That's going to be another sluggish 2 quarters.
This is the same report from CNBC also highlights the fact that home buyers, though, aren't reacting as much to the slightly lower rates. Purchase applications barely moved, up 0.1%. Why do you think home buyers are more reluctant, or still reluctant now, despite lower rates?
It's a clear case of an affordability problem. I mean, it's not like inflation is non-existent, or it's not like people are still recovering from the high inflation of 2 years ago. Like, wages have not necessarily kept up. There is some creeping bad news in the employment scene in the U.S. I just looked at some data just this morning about new car sales really sort of quieting, particularly in some categories. And that would tell me that the U.S. consumer, which includes home buyers, is a little reticent right now.
Okay. Actually, this is a good segue to this Harvard joint study on housing report that I want to bring to your attention too. Like you just said, housing faces valuations problems. In 2025, households and housing markets face an ever more challenging environment. High home prices and elevated interest rates reduced home buying to its lowest level since the mid-1990s. Increases in both insurance premiums and property taxes have heightened financial stress on homeowners and landlords. And despite an abundance of new apartments, high rents have left more people than ever cost-burdened and have contributed to a sharp rise in homelessness. Meanwhile, unprecedented destruction from wildfires has further highlighted the growing threat to the housing market from climate change. So let's just take what we've read so far. Ron, first of all, do you agree with this general assessment? We'll start there.
Well, I can't say that I believe a lot of housing stock is burning down, but what I will say is that it speaks to the general unaffordability in the housing space, rising insurance premiums, higher interest rates, much higher. It wasn't too long. It wasn't that long ago that interest rates were 2.99. I mean, this is still this is more than double still 3 years later. So we can't pretend there isn't still some sort of shock. And more to the point, food inflation, HOA fees, property taxes, you name it. Nothing's down, everything's up, and it's not like wages have kept up perfectly. They have not. So that is going to lead to a more difficult and a sluggish environment for home buyers.
Okay, so what this report highlights and what you've talked about a bit is the excess in inventory. So what's next? Are we going to see a correction in home prices, or do you think home prices will stay elevated and unaffordable for quite some time?
Well, everything is regional. I mean, you could say that right now, South Florida is experiencing a very difficult time, maybe one of the most difficult times since the great financial crisis, brought on by new condo legislation, new requirements to increase condo fees. There's a lot of issues down there. Other areas are doing well. I don't think Texas is falling flat, although Austin is down. Austin, which had the most spectacular rise in prices, has now kind of bottomed down a bit, still higher than its 2018 levels. Look, I mean, in general, new home sales are tough because you just don't have easy ability to get that mortgage. It's still hard. It's still challenging with these rates. You're not going to see any real substantial increase in new home purchase until rates get below 5. The rates get below 6. You need a rate that starts with a 5.
The report also mentions that home prices have grown by about 60% since 2019. To my knowledge, real wages have not increased by 60% since 2019. So, like you said, valuations and high home prices make this unaffordable. What, if anything, has changed in terms of home buying strategies to mitigate these difficult, unaffordable times?
The bottom line is that you cannot create an environment where home buyers are going to rush to market. New home buyers are going to rush to market with rates that start with a 6. I mean, it's just not feasible. 6.79 is not radically different than 7.19. It's a little bit more affordable, but it's not in any major way more affordable. So you're just not going to see a rush of new home buyers to the market, a rush to buy new construction. You're just not going to see it till we get a substantial rate drop.
The report also highlights a surge in rental demand. That kind of makes sense. If people aren't rushing to buy homes, they have to rent. So how is the housing market going to change? The landscape of housing going to change in the foreseeable future, if it is going to change at all? Do you think that fewer homes will be owned and more rented?
It's still highly regional. There are parts of the United States that do not have they don't have a struggle to find. They're looking for renters. Renters are not necessarily struggling. But in certain key markets, which attract, particularly markets where people are coming out of California to go to other states, yeah, you're seeing some difficulties in the rental market there. There's probably, with a little bit of time, it will catch up and rental rates will fall back in line. But again, with high interest rates, development costs are expensive. I mean, you've got a higher threshold of cost to get your project going to build those rental units. So yeah, we're going to see a temporary surge in rents, as you're expressing, but it will in all likelihood resolve itself.
Do you think the home ownership affordability crisis has delayed household formation, ultimately changing demographics?
We see it. We see it in all the Western world. We see the fact that in the countries where house prices and unattainability of buying a new home has really slowed down family formation or greatly diminished the size of the family. I mean, sure, there are some social reasons as well. We can't pretend there's not. But the reality is, in a country where it's easy to buy a house as a young person, a person in their 20s, it's a lot easier to start a family. And that's just the truth.
So what can the average household do? Let's just talk to the average person watching this show now to manage their personal finances in such a way that they can manage higher insurance premiums, like I stated, perhaps higher rent. If they're paying a mortgage, well, the rates haven't come down substantially. If they're looking to buy a home, first or second home, prices still remain elevated. Costs, generally speaking, of owning and or renting a home has just increased. What can we do?
The simplistic answer is to seek low-cost locations, to seek lower-cost states, lower-cost regions. That's not always easy. It's not easy for people to leave their families behind. It's not easy for people to move across the country. But that is obviously, it's one answer. I look forward to seeing a time where the Fed does reduce rates in a more substantial way, where there is a better mortgage rate environment for people. Let's face it, as I said, a rate that starts with a 5, I'll tell you, a rate that starts with a 4, even if it was 4.99, would revitalize this whole purchase situation.
Yeah, the big beautiful bill, coming back to that, you mentioned that before. How is that going to change cost of ownership? Do you think there's, Trump wants to slash taxes across the board? Do you think some of these taxes may impact the housing market, or these fiscal policies may change the way the housing market operates and people, own homes?
Well, I think the first thing to understand is there will be a new Fed chairman next May. There will, and as the various Fed governors come up, there's going to be new people in place. I am absolutely certain that once the big beautiful bill goes through, one of the administration's key obsessions is going to be with mortgage interest rates. I mean, it's a bit of an obsession now, but once some of the other priorities are out of the way, I think we're just going to watch it grow. So I don't know by what means they will take to address it, but I'm sure it's on the list. And as other things get checked off the list, it becomes a bigger and bigger issue.
Which regions are most at risk of a housing correction, and which regions are the opposite, most ripe for some sort of growth?
Well, Florida's already experiencing some right now. There's possibilities we'll see some, one of the things about AI is that the AI revolution is actually regional. You think about where there's lots of lawyers, copywriters, writers, you think of various companies that could be bankers, companies that would be affected by great efficiencies in AI. You're also looking at probably the loss of jobs. And that is, let's face it, that is the Northwest and the Northeast, and to a certain extent, California. So that is something it's not immediate. It's more midterm, but it's certainly something that could happen.
Loss of jobs, meaning people will move away from those areas, or rise in homelessness, or higher renting demand. What does that mean?
Probably means all the above is what it means. But also seeking regions where AI is not as impactful. If you got a place like New York City, Philadelphia, Boston, sure, there's great tech centers around the Boston area. But if you think about New York, Philadelphia, and New Jersey, you're thinking about places where there's a lot of banking, legal, consulting, infrastructure. Now, I've talked to law firms that firmly believe, a 200-person law firm will soon, and I'm talking 18 months, be a 110 or even a 90-person law firm. They just won't need the people in the seats.
Okay, let's shift gears now and talk about Canada. You've called for mortgage rates in Canada to drop to 3.89%. You were right, by the way. And Ultra Financial in June showed that 5-year fixed mortgage rates, reached 3.89%. So congrats on that call. What's next for mortgage rates in Canada? But just before we talk about mortgage and rates, let's just assess Canada overall. I think we spoke before the Canadian election. Yeah, we did. So now that Carney is officially PM, how is a second Liberal Party going to change, if anything, the landscape of homeownership in Canada?
Nothing's going to change. The government has no effective programs in mind. Their signature program, which has to do with creating a government agency that will build houses, is destined to be a failure. And so we see no particular change from the government. We suspect there's still a decent chance of further Bank of Canada cuts, although I'm not as positive about a better fixed rates in the near future. What I will say is this: there will be continued chaos in the condominium space in both the Lower Mainland, Vancouver, and in Toronto. It will just worsen over the course of the next 6 months. There will be more reduction of values, more problems with to sell properties. There will be continued chaos in new construction as those 6-year projects that have been being built for 6 years come due. There will be more and more failures to see buyers complete their contracts. It's going to be very chaotic in the high-rise condo space in the two cities in Canada where they're a big deal, which is Vancouver and Toronto.
Yeah, we're seeing that now. I'm living in Vancouver. What you're saying is true. Even new buildings being built, developers have been pre-selling units to many foreign investors who were hoping to flip it for a profit. Actually, many of them have been holding off selling units as soon as the properties were finished because they would have to suffer a huge loss, write down a big loss. So they ended up renting instead. What does this mean for the home building market now that this rosy picture that developers were painting 5 years ago is obviously not coming to fruition?
Well, we're going to see considerable unemployment in construction trades in certain provinces in British Columbia and Ontario. In Ontario, it's well underway. We suspect there'll be a almost catastrophic crash in construction jobs by the end of this year and continue into the first 2 quarters of next year. And there's literally nothing being built. I mean, I think we're talking about multi-decade lows that we're starting to talk about a housing building disaster that's going to be about the same as 1990. And there's roughly 35% more humans in these areas since 1990. And yet just as bad, just as few buildings being built, just as few homes being built. In fact, the whole industry, commercial's in bad shape too on the construction side. So the whole industry is kind of hanging their hat on government building, is on building hospitals, building rental properties through government programs like CMHC or this new Build Canada Homes program. It's going to be a very bad time. Now, other regions not so bad. The Alberta housing scene is not too bad, although it is not as robust as it was a year and a half ago. Quebec has been strong, but again, some signs of it leveling off in the last couple of months. So, look, we're just going to see a very difficult time in the Canadian real estate space for the next year.
Well, let's just evaluate some of the Liberal Party's plan for housing, existing plans rather. So as outlined in their 2024 budget, their Build Canada Homes initiative is a new federal initiative to basically act as a developer building low-end and affordable housing across the country. First of all, let's just take a look. How is that going so far? And if that actually goes according to plan, wouldn't that create construction jobs?
Well, if there's nothing happening right now. I mean, there's we had the housing minister out in the one Atlantic province looking at a project that was actually started over 18 months ago. Look, it's really important to understand this. This entire idea was done in New Zealand starting in 2018. 2018, New Zealand under the Prime Minister Ardern created an entity called Kiwi Build. And it's 1/8 the size. New Zealand's population is 1/8 the size of Canada. So Carney's proposing building 500,000 homes per year. The New Zealand plan called for 100,000 homes per year for an 8 times smaller population. During the course of the 5 years that the program existed, they built 2,389 homes instead of 100,000.
What went wrong?
Everything went wrong that could go wrong. The creation of the agency took an enormous amount of time because of government bureaucracy. They were absolutely terrible at what they did. They didn't involve private enterprise in it. They didn't involve existing developers or existing construction companies. They tried to go modular. Modular didn't work. And they discovered something amazing. They discovered that actually the problems are the price of the land, which is also very expensive in Canada, in regions of Canada, the difficulty with getting rezoning, the difficulty with getting infrastructure, and the difficulty with high local taxes on new builds. So they actually experienced in New Zealand everything that goes wrong here, except they experienced it as a government agency, and they failed completely. Like, I'm serious, 100,000 proposed, they ended up with 2,389 homes. Exactly the same program. Emphasis on modular, emphasis on affordability.
Well, this is exactly what it sounds like they're planning to do. By the way, I'm referring to this particular press release. Mark Carney's Liberals unveil Canada's most ambitious housing plan since World War II. So during and after World War II, Canada was facing a massive housing crisis similar to today's. In response, the government of the day built tens of thousands of affordable starter homes. So this is what we're talking about over here. $25 billion in financing initiatives to catalyze housing industry. Carney's government will double the pace of construction to almost 500,000 new homes a year. And additionally, this is important. $25 billion in financing to help home builders. Can we just talk about that part? How is that going to help home builders?
Well, the important part to understand about all this is when you see the word affordable, which appears several times, you need to understand it's code for socialized housing. These are not homes anybody could buy. These are municipal homes that are sponsored through the cities and towns, which are subsidized housing for people who are in need of that kind of rental housing. So none of this is really about homes to buy. The whole idea of modular homes is often focused on rental properties. So the difficulty again here is it ignores the real problems in Canada. The problems in Canada surround the extremely high cost of land in the big cities and the surrounding areas, the massive amount of development fees and accrued costs when you have to pay to government when you want to build a place, the unbelievable amount of red tape and expensive infrastructure you have to go through to be able to start to build a subdivision. For most developers, it takes 3 years of report creation before they ever get to the point, and they've had to pay the interest on the land all during that time, on the land loans. So it is just absurdly expensive, incredibly complicated, and it just enmeshed in horrific regulation. That's the real issues. If you could somehow get rid of 80% of the regulation, reduce the development fees, which are essentially a tax on the new home buyer, by 80%, you could accomplish everything the federal government wants to do without having to invent this Build Canada housing program. If you just got rid of the impediments that construction companies and developers face today.
So if you were
you're
housing
not going to
minister,
fix that.
Right. So if you were a housing minister, what would you do besides? So you said lower development costs. What else?
Lower development costs and throw out. Right now, it takes 3 years and 24 different reports to get to the point where you can actually apply to build a new subdivision. So it's an incredibly complex and difficult process. I would take that back to the 4 reports. You know, when we talk about the massive amount of home buildings after World War II, there were only 2 things you needed to analyze. You just had to analyze water table and where the roads are going to go. That was all the work you had to do to build a new subdivision after World War II. You didn't have to determine whether the purple-toed salamander is going to be nesting in that area. You didn't have any. You didn't have to analyze the entire history or archaeology of the area. You didn't have to check for arrowheads or broken plates from people from 200 years ago. All the stuff we have to do today that's ridiculous, they didn't have to do in 1950, and therefore they could build houses efficiently and cheaply.
So basically, stay out of the construction business. I'm talking about the government, and let the private sector take care of it. Just reduce roadblocks for the private sector. Am I getting that right?
You're getting that right, because the private sector has got a ton of unemployed construction workers. They certainly have even more by the end of this year, and they will be ripe to build efficiently and cheaply if you give them a chance.
Okay. Ron, I understand sort of why the government's doing this, because maybe the constituents want them to do something about the housing affordability crisis right now. So let's say I were somebody, just a regular person living in, a liberal dominated area, and I would say, well, Mr. Carney, or the MP in my region, I would say, hey, look, it's unaffordable now. I need to buy a home now. Even if we let the private sector take over and reduce roadblocks, lower development costs, all that, it would take years for new housing supply to come online and perhaps dilute the market and lower housing costs. But I want to be able to afford a home now. So should the government provide subsidies to lower income families now?
They don't need to provide subsidies if they just insisted that municipalities reduce. I'll just give you simple numbers. In the city of Toronto, on the average high-rise condominium, the government adds $94,000 to the cost of the condominium. On a single-family home in the city of Toronto, they add about $260,000 worth of cost to the single family home through these development fees. If you just said, hey, City of Toronto, you can't charge any more development fees, or you go back to where development fees were in 1995, when they were $1,300 instead of $260,000, just go back to that. Those builders will start building, and they'll start building fast. But if you continue to maintain outrageous costs for builders that have to pass it on to the home buyer, you're not going to get past go. And that's what we're up against right now.
We talked about this last time. The Toronto condo market is ranked as one of the top 5 most expensive markets in the world, up there with Zurich. So, what ultimately is the core of the problem here? You've highlighted a few problems, including bureaucracy and costs. But is this a purely demand issue that we're talking about? Too much demand for a city?
This is a endless series of mistakes issue. So there were some incredible pricing errors made in 2000 and 1999 and 2020. In 2020 and 2021, where the price of some of these condominiums doubled on a pre-sale basis from just 5 years earlier. So none of those are economically viable anymore. Those buildings are going to complete, and there's going to be a bloodbath of losses that are going to be incurred by the people who signed those contracts. And there's about 45,000, 50,000 of those contracts out there just in the GTA. So we're going to see a bloodbath there. Look, I think if we just wait patiently for 18 months, we will learn that Toronto condominium prices are no longer rivaling Zurich and other places, that they're going to come right back down, all on their own. They're going to drop all on their own.
What about tax policies here? This is going back to the Liberals' plan. The Liberal housing plan will build on the elimination of the GST for first-time home buyers on homes at or under $1 million. By the way, that's less than half of Vancouver. But anyway, I'll let you comment on this. Is this a step in the right direction, at least?
Of course, it's a step in the right direction. I mean, any reduction of the tax regime that directly affects first-time home buyers or new home buyers is a welcome benefit, but it can't. That's just scratching the surface. Until the federal government addresses the insane levels of municipal tax in terms of new builds that exist in the Lower Mainland, that exist in the GTA. For instance, if people wonder why they're still building a ton of homes in Calgary and Edmonton, they're building a ton of homes because this $260,000 development charge that exists in Toronto to build a brand new single family home is about $28,000 in those locations in Alberta. So when you've got a 10x difference, you're going to have some trouble in the Toronto area.
What about foreign investment? The theory is that foreign direct investment has been driving up prices. What can the government do about that? Should the government intervene in that market?
We've had an investment ban in Canada for almost 3 years now, 2.5 years. So no foreign buyer can buy any property in this country. And it's having its effect. I mean, it just is having its effect. The sale of brand new condominiums, when you sell a condominium, a high-rise condominium, you've got to take deposits now for a future delivery in about 5 years. That's true in all these big cities for high-rise condominiums. So there's absolutely zero foreign buyers for the last 2 years in that particular space. And the new sales have completely collapsed. So there's no new high-rise condos getting built in Vancouver or in Toronto. None at all.
Do you support this plan?
Look, I mean, to tell you the truth, the foreign buyers probably wouldn't come anyway right now. I mean, a foreign buyer is also someone who recognizes that there's problems in the marketplace and they're disinterested in buying right now in most parts of Canada. So I think if it went or if it stayed, it would have no impact. But I am basically of the opinion that it doesn't make sense why we should encourage foreign nationals to buy homes that are designed for Canadian families who have a hard time buying. I just don't really understand the reason behind that.
Do you think down payment requirements will be changing anytime soon from financial institutions and banks? Are they constantly adapting to the market?
Well, there is very little adaptation. The only adaptation we experienced was about a year and a bit ago when the federal government introduced a increase in the maximum in terms of CMHC coverage. CMHC went to a $1.5 million property. It only requires a 10% down payment. So that was a big, big change. And yet it's got relatively little uptake in this sort of depressed housing market we have. They expected somewhere an increase of the magnitude of, say, 20 or 22%. They only got about 8. So it's just a bad housing market right now. But the federal government has made moves to try to encourage lower down payment for first-time home buyers. And it's just plain too expensive right now. Again, same kind of issues as the U.S., affordability problems, and the prices are just too high.
All right. Capital gains taxes on secondary properties and investment properties. Do you see that changing under Carney?
Well, those taxes exist as we speak. I mean, the suspicion of the constant suspicion of the new government is there will be some sort of limited capital gains on primary residences if there has been an enormous run up in the value of that property over the course of time. Again, probably not applicable to situations where the value has not increased much over the last 10 years. But I don't necessarily know that it's going to happen. It is probably the most damaging policy that Carney could enact. A capital gains tax on primary residence is probably the most damaging policy you could ever imagine for Carney's voter coalition. It's something that would cost him the next election for sure. So I don't see that in the future. The capital gains changes that were proposed under the Trudeau government have been removed under the Carney government. And so their application to properties is vanished. I don't really see much chance of major tax changes in the housing space.
Overall then, besides the condo market in Canada, which we've talked about extensively today and in the last podcast, what about single-family homes, townhouses, the other areas of the housing markets? How do you see those spaces developing in Canada?
Low-rise dwellings. Again, that market in Ontario, Southern Ontario, most of Ontario is completely dead. It's in a severe decline in British Columbia as well. It's percolating along just fine in Alberta and the rest of actually Saskatchewan, Manitoba. New home construction is up about 10%. Quebec up about 10%. But in British Columbia and Ontario, they're not building any new low-rise homes either. No single family, no townhouses. It's just too expensive to get the subdivision permissions. In British Columbia, Vancouver's hemmed in by geography. And in Toronto, the government has built an artificial moat around the GTA called the Greenbelt. And doesn't look like any changes there. So what we've got here is literally, there's zero construction going on in Southern Ontario. I mean, yeah, there's a few subdivisions getting finished, but no, there's no new starts of anything. So eventually that scarcity will come into play. There could absolutely be a kind of a rally in low-rise prices, single-family townhouse prices in 2028, 29. That's possible because there just will be a great scarcity of product.
Well, I heard the opinion that, I'm speaking about Vancouver, but maybe the logic applies everywhere else, that because developers have been focusing so much on high-rise dwellings, condominiums, that the scarcity of supply of low-rise dwellings is going to start kicking in, meaning that demand is going to start outpacing the supply growth, and that's where the growth is going to be. Does that logic make sense?
The thesis is correct. There's just been a drastic reduction in the building of low-rise properties. But unfortunately, the price points of these low-rise properties haven't really budged much. If we look at, if you want to buy something in the northern regions of Toronto, even if you go into the suburbs, the 905 region, most of those properties are being offered at $2 million for a single-family home. So the affordability crisis in Canada means there's just not a whole lot of appetite for that kind of pricing. Until that pricing starts to budge, or whole new design programs of smaller homes, or again, radical reduction in taxes, radical reduction in development fees. Until that happens, I don't think you're going to see a very lively marketplace if the bulk of those single-family homes start at $1.7 to $2 million.
So who are the buyers right now, the demographics of people that are able to afford homes, whether it be condominiums or low-rise dwellings? Who are they? Will this demographic change?
Well, there's simply no buyers for condominiums. There's like a multi-year supply of listings that just go unsold every month. because the mathematics of the condominium space don't make any sense right now. There will be a marketplace for buyers of low rise eventually, and they will be move up buyers. They will be, once the market stabilizes to a certain extent, affordability improves, some of these taxes development taxes start to come down. Things like Carnation initiative on the new homes starts to come through. We're going to see some pickup in the low-rise space, but again, I am hesitant to think that it will be any time before 2027.
On that note, in terms of timeline, let's say if we were somebody who is looking to buy a home, either as a first-time home buyer or as a second home, whatever the case may be, given how distressed the market is, should we get in now or should we wait still?
Oh, you should wait. You should absolutely wait. Whatever stress exists in the market today, it will be significantly more by the end of this year. We'll see substantial reductions in the price of condominiums by Q1 next year. And that may really be the time to look at that particular product. And again, I would still suggest that 2026 would be the time that people should start thinking about buying low-rise properties. There's still a lot more lethal problems in the marketplace that are going to come into play in the next 6 months that it doesn't make much sense to try to catch a falling knife now.
I'm just wondering, this is just my theory, if everyone thinks like you, Ron, and a lot of people do agree with you, if everyone's waiting because they're expecting the market to either worsen, like you said, or rates to come down more, potentially, maybe now is a time to front run all the buyers that will be coming in 2026. What do you think?
Well, housing doesn't work in the efficient manner that equities does, or that any other kind of easily traded commodity does. Housing is slow. It's like walking through mud. When you think about 1990, there's a major correction in Southern Ontario in 1990. The prices didn't start to move up until 1996, Q1 1996. Q4 1995. So that was like a 5-year sort of drop, plateau, edging down, and they never recovered inflation-adjusted pricing until 2012. So it could be a long run in homes. It could be a very long run. That's why I continue to think that there's no urgent financial rationale to jumping in immediately. But some people will. Look. Nothing stops somebody whose wife's expecting twins or triplets to want to think, I better find a bigger house. I mean, there's just human needs that come up. But in terms of a real financial thesis to buy homes, no, I don't think we'll see that this year at all.
What about existing homeowners who have properties for rent? How do you see cap rates changing in the next year?
Rental rates are falling across Ontario and also in British Columbia. We think that will absolutely continue for the next 3 quarters, and there will be no end in sight for lower rental rates as time goes by. There's still about 40,000 new condo units that will come on stream in the next 18 months to 2 years. That will put further pressure. Oh, and by the way, in terms of rental stock, we've never had a bigger expansion of rental stock, purpose-built rentals, for the last 40 years in Canada. We expect that in Ontario, we will add 7% of the entire existing rental stock to Ontario in the next 12 months. They're building that many purpose-built rentals through the CMHC Select program. It's same, not much different in British Columbia. There's going to be a lot more purpose-built rentals in the Lower Mainland and in the interior in the next 12 months, which will further put pressure on rents. So it's going to be one of the worst times to be a landlord in those 2 provinces that anybody could expect over the next 12 months.
So if you're an existing homeowner, what should you do? Hang on to your property for now?
Hang on, wait, watch, become very observant next year or at the end of this year. If you're a renter and your lease is up, it's time to start shopping, and you better shop hard because there are some great deals out there. Hardly in Southern Ontario and most of Vancouver, there's not a single offer that doesn't come with a free month's rent, whether it's the first month or the last month. So and let's face it, for the last 10 years, that was almost unheard of. So this is a great time to rent, so get out and shop.
Okay, good. Thank you very much, Ron. Tell us about your work. Tell us a little bit about yourself and where we can find you.
You can find me at butlermortgage.ca, or you can find me as Ron the Mortgage Guy on X, or the Angry Mortgage Podcast on YouTube. We're just all over social media, TikTok, you name it. Ron Mortgage Guy, Instagram. We're easily found, and we put out content every single day, which we hope helps Canadians make mortgage decisions.
We appreciate your time. We appreciate your insights. Thank you very much, Ron, and a happy belated Canada Day. We'll speak to you again soon. Take care for now.
Thanks, David. Appreciate it.
Thank you for watching. Don't forget to like and subscribe and follow Ron. The link's down below.